What if I told you that right now, today, three specific money decisions you're making are literally stealing hundreds of thousands of dollars from your future self? I'm not exaggerating. These aren't theoretical mistakes. We're talking about real dollars, real compound growth, and real opportunity costs that most people completely ignore until it's too late. Stick around because we're breaking down exactly what these three mistakes are, why they're killing your net worth in 2026, and most importantly, how to fix them starting today. Welcome back to Money Mindset TV. If you're new here, we cover everything from the stock market to side hustles to real estate, and we keep it real. We don't sugarcoat things, and we don't chase trends. What we do is give you the actual data, the current market conditions, and actionable strategies that work right now. Let's set the stage. We're in July 2026. The S&P 500 is sitting at 744.78, down about 1.3% this month. The Nasdaq has taken a harder hit, down 4.2%. But here's what most people miss. While the headlines are screaming about market volatility, the Fed is actually signaling they're less likely to raise rates as job growth slows. That changes everything about how you should be positioning your money right now. And if you're still making the three mistakes we're about to cover, you're missing out on the exact window when strategic moves matter most. Let's jump into mistake number one. And honestly, this one might be the most expensive mistake you're making without even realizing it. Mistake number one is keeping the majority of your money in low-yield savings accounts, money market accounts, or checking accounts that are basically paying you nothing. Look, I get it. The 2008 crisis happened. People got burned. There's a psychological comfort that comes with having your money in a bank. Accessible, safe-looking. But here's the brutal truth. That comfort is costing you an absolute fortune. Let me give you real numbers. Say you have $50,000 sitting in a traditional savings account right now earning 0.5% annually. That's $150 a year. $150. Meanwhile, there are high-yield savings accounts available today through platforms like Marcus, Ally, and even some traditional banks that are offering between 4.2 and 4.7%. That same $50,000 would earn you $2,000 to $2,350 a year. We're talking about the difference between $150 and over $2,000 in 1 year. That's an extra $2,000 you're leaving on the table because of inertia. But here's where it gets really insane. Compound that over 20 years. That extra $2,250 a year at 4.5% interest, reinvested, doesn't just grow linearly. It compounds. You're looking at potentially an extra $170,000 in your net worth 20 years from now, just from moving money out of a garbage savings account into a decent one. One decision. Not timing the market. Not picking winning stocks. Just moving your cash to a place where it actually earns something. Now, if that's your emergency fund or money you need within 2 years, high-yield savings is the right move. But what about money you won't touch for 5, 10, 20 years? This is where most people get it wrong. They're still holding long-term money in savings accounts because they think the stock market is too risky right now. And I'm going to hit this hard because this is mistake number two. Mistake number two is avoiding the stock market or sitting on the sidelines during volatility. And the timing on this is absolutely critical because we're literally living in one of these volatile periods right now. Look at what's happening. The Nasdaq is down 4.2% this month. There's uncertainty about the economy. Job growth is slowing. The Fed might not raise rates. When people see headlines like that, their instinct is to pull back, to wait for things to stabilize, to get into the market when things feel safer. But here's the thing about that strategy. It's statistically one of the worst approaches to building wealth you could possibly adopt. Let me give you a historical perspective that applies directly to today. If you had invested $10,000 in the S&P 500 at the absolute worst possible time, the peak right before the 2020 COVID crash, and you never added another dollar, never timed the market, never tried to be clever, that money would be worth approximately $22,000 today. 6 years later. $22,000 from $10,000. That's a 120% return despite living through a global pandemic, political chaos, inflation, rate hikes, and market volatility. But most people weren't in the market during that time. They were sitting on cash, waiting for the perfect entry point that never came. Here's what the data shows. Missing just the 10 best days in the S&P 500 over a 20-year period cuts your returns roughly in half. Not by 10%, in half. And the thing is, nobody knows when those 10 days are happening. They often happen right after the worst crashes, when everyone's terrified. So if you're sitting out right now waiting for things to feel safer, you're almost certainly going to miss some of the best returns. The real move right now is called dollar cost averaging. You don't try to time the perfect bottom. Instead, you invest a fixed amount regularly. Could be monthly, could be weekly, regardless of market conditions. You buy more shares when prices are low and fewer when they're high. Your average cost basis goes down. And here's the math. If you're investing $2,500 a month in a simple index fund like VOO or VTI, you're building serious wealth systematically. Over 10 years at historical market returns, that's an extra $150,000 to $200,000 in your portfolio, depending on market performance. But most people aren't doing this. They're sitting on the sidelines because they feel like they're missing something. They're waiting for the perfect moment, and they're costing themselves life-changing money in the process. Now here's the nuance that matters in July 2026. Yes, the market is down this month. Yes, there's volatility. Yes, there's uncertainty. But you know what that means? It means better entry points for the next 20 years of growth. The money you invest today at lower prices is going to compound harder and faster than money you invest when prices are at all-time highs. So, volatility is actually your friend if you're a long-term investor. The only people who get hurt by volatility are the ones trying to day trade, or the ones who panic sell after they already bought at the top. The move is simple. Increase your monthly contributions, if anything. Take advantage of lower prices. Your future self will thank you. Now let's move to mistake number 3, and this one is what separates people who build wealth from people who just have a job. Mistake number 3 is not building multiple income streams. And I'm not talking about some vague side hustle concept. I'm talking about a specific deliberate strategy to diversify your income so that you're not completely dependent on one paycheck. Here's the reality. If 100% of your income comes from an employer, you have a fragile financial situation. You have zero control over your income. You can get laid off, your industry can change, your company can downsize, or you can just reach a ceiling where raises slow down. And that's a problem. Look at what successful entrepreneurs and wealth builders are doing right now. They're not just running one business. They're building multiple revenue channels. It could be an e-commerce brand, a course, a service-based business, rental properties, dividend stocks, a podcast with sponsors. The specific thing doesn't matter. What matters is that income isn't concentrated in one place. Let me give you a real example of what this looks like economically. Say you make $100,000 a year from your W-2 job. That's your baseline. Now what if you built a side income stream that generates an additional $500 to $1,000 a month? That's $6,000 to $12,000 a year. Not life-changing immediately. But here's where it gets interesting. That additional income, when combined with the investing strategy we talked about earlier, accelerates your wealth building dramatically. That extra $12,000 a year invested at market returns compounds into hundreds of thousands of dollars over 2 decades. But more importantly, that income stream gives you options. If your primary job situation goes sideways, you don't panic. You have runway. You have choices. The key right now in 2026 is that building income streams is easier than it's ever been. You can start a dropshipping business on platforms like Shopify for under $50 a month. You can launch a digital product on Gumroad or Teachable. You can offer freelance services on Upwork or Fiverr. You can create content and monetize through YouTube, which is what we do here at Money Mindset TV. You can invest in REITs through Fundrise or Yield Street if you want real estate exposure without managing properties. None of these require a massive upfront investment or special credentials. But here's what kills most people. They don't start. They wait for the perfect idea, the perfect timing, the perfect knowledge. And while they're waiting, they're missing years of compound growth on that income. The move is this. Pick one income stream, just one. Commit 30 to 45 minutes a day to it for the next 90 days. Track the results. Either double down or pivot to something different. But you have to start. because the only income stream that guarantees $0 is the one you never build. So let's recap. 3 mistakes that are killing your net worth right now. Mistake 1. Keeping long-term money in garbage savings accounts instead of moving it to high-yield accounts or strategic investments. That's costing you potentially hundreds of thousands over 2 decades. Mistake 2. Sitting on the sidelines during market volatility instead of dollar-cost averaging into index funds. That's costing you even more because you're missing compound growth during the exact periods when future returns compound the hardest. And mistake 3. Not building any income streams beyond your primary job, which keeps you trapped in a fragile financial situation with no control and no leverage. The fix for all 3 of these isn't complicated. It's not rocket science. Move your emergency fund to a high-yield account like Ali or Marcus. Automate your investment contributions into VOO or VTI, regardless of what the market's doing. And pick one side income stream and commit to building it for the next 90 days. 3 decisions, 3 moves. These are what separate people who build wealth from people who wonder why everyone else seems to get ahead. Now, I want to know which of these 3 mistakes you've been making. Are you sitting on cash earning basically nothing? Are you trying to time the market? Or have you been putting off starting a side income stream? Drop a comment down below. Tell us which one hit you the hardest. And if you're ready to actually fix these mistakes and take control of your net worth, subscribe to Money Mindset TV. We drop new videos every single week with current market data, actionable strategies, and the real numbers behind wealth building. The difference between someone who builds serious wealth and someone who doesn't isn't luck. And it isn't intelligence. It's just consistency and information. We're here to give you the information. You just have to show up. Let's go.